Hey, welcome to Current Yield. This is Grant's Interest Rate Observer of the Air, and I am Jim Grant. And with me, as always, is the great deputy editor of Grant's, Evan Lorenz. And as per usual, Henry French is at the control panel. And today, sitting to my right, directly across from Evan, and to Henry's left is Jeremy Mindich.
Great to be here.
Founding, I'm going to call you a partner of
that works.
Scopia Capital. Yeah, you know, I began the day with 3 inflation shocks. I bought the usual quartet of newspapers today. It wasn't $12.50, it was $13.50. I remember a time when you plunked down 25 cents in silver and you got yourself the Wall Street Journal, the New York Times, the Post, and the Daily News. And, okay, that was the first. Second was I got my teeth cleaned. What do you think? Worth it, right?
Yeah, really good.
Yeah, except it was $325 today rather than the prior $275 for cleaning and a glimpse in my mouth. That's a privilege the dentist gets. So that's up 18%, which 18 happens to coincide with the cost of one sandwich, egg salad, and one canister of soup, not filled to the top at Pret. $18. So I'm thinking that this disinflation thing, which we all pray for, is taking its sweet time.
Yeah. I think you got a bargain. I actually bought lunch at Pret today too, a soup and a sandwich, and they charged me just over $20, which made me fatter and my wallet lighter.
Well, I think you have to be a little bit better at negotiation, Evan.
It's also a sign of the times that you guys don't eat at the Downtown Association anymore.
Yeah,
that's kind of an obscure reference.
That was DTA was closed during the Troubles and reopened. Not. I think it's still kind of a soft opening. Hey, the last time I spoke to you on the air, I invited listeners to send me an email for request a sample of Grant stories. Some of you did, so I want to thank you for that. Hope you enjoyed them. But speaking to you and of you listening to us, hey, let us know. Is there anything you particularly want to hear about? You know, topics or any guests you'd like to hear us interview, or maybe if you're a subscriber to Grants and have questions or would like to know more about something you've read in a recent issue, and if we can come up with an answer, not guaranteed, shoot us an email at podcast@grantspub.com. That's podcast@grantspub.com. Yeah, so thank you for listening. So we are here, ladies and gentlemen, to talk about buying low and selling high, and we are with a most accomplished practitioner of it in Jeremy Mindich and his firm Scopia Capital. Scopia is from the Latin meaning scoping.
We use it because of the root of microscope. I was thinking about the microscope as a in its day cutting edge technology and advancement in healthcare. We had an interest in healthcare and technology greater than the average value fund. But you couldn't call your hedge fund group Microscopia. So we cut it down.
Or it could have been Macroscopia.
Yeah.
So Jeremy, I've known Jeremy for more than 20 years. Jeremy and I were fellow practitioners of the value school of buy low, sell high. We were both assisting in a Japanese long only fund, and we started in 1999. Ken Shirley and Alex Porter and you and we started in 1999
with all the best intentions.
Or 1998, I think.
Yeah.
Yeah. No, the best intent was to get rich, and Ken traveled to Japan and remained there, and we bought stocks that were trading for less than their net current assets in 1998. And in 2006, they were trading for less than their net current assets, having compounded book value along the way at respectable rate and paying out dividends much greater than the Japanese 10-year stupid bond yield. And it was instructive and not unrewarding, but disappointing in the failure of the famed Graham and Dodd value focus to deliver more substantial results.
It was disappointing. It was such a great idea, and the fact that this opportunity existed seemed hard to imagine. And in retrospect, what it taught me, and maybe you as well, is that how managers deploy capital is as important as the capital they have on the balance sheet.
Yeah.
And that as investors, we are constantly looking at handing over the responsibility of allocating capital to the managers that we invest in. Just like an investor in our funds gives us that responsibility to pick the best investments in the universe that we look at for them. And in Japan, there was just this unwillingness to use that balance sheet capital in productive ways. It seemed economically impossible that would happen, but that's exactly what happened.
Yeah. Well, the story going in was irresistibly contrary, and I thought and still would think, if presented with it, marvelous. Here you have companies that. Anyway, not to. But let's get back to.
Can I just ask a quick question? Did you
Yeah.
ever ever rerun that screen, or is it too painful to try it?
I have not. I know. Some of these companies did get bought out at substantial premiums to what we were. But I think the payoff was many years after we folded. Speaking of, however, as I say, the present here and now, the topic is Scopia and its market neutral strategy. I'm gonna describe this, Jeremy, and you. I'm gonna take 30 seconds, and you may fill out some of the details, being rather better informed. But Jeremy and his partner Matt Zarovich have been at this for rather more than 20 years, and the idea from the beginning was to be long, opportunistically, short, opportunistically, and through the excellence of the stock picking, the perception of the stock picking, and was to deliver solid returns through thick and thin, and especially thin. The idea was to be investors, right, and not to be riding waves, not to be throwing money at macroeconomic trends, but to look security by security, having no particular emphasis on a sector or what they call now a factor, and to make money by dint of microscopic analysis of merits of the business. No.
Yeah, exactly. I mean, I think it's even stronger than that in the sense that the typical sort of historic A.W. Jones model of hedge fund investing was something like 100% long and 50% short.
Yeah.
And to this day, most fundamentally driven long short hedge funds run fairly net long, 20, 30, 50% net long. If you see the correlation of the typical hedge fund to the S&P, it tends to be pretty high, something like 0.8 correlation or so, which is okay if you're outperforming the market, but if you're not outperforming the market, it can be disappointing. Our strategy from the beginning was to try to create a return stream that had no correlation to the market, that had no exposure to, on a meaningful level, to sectors or factors, and really create a return that's only based on the difference between the greatness of our longs and the vulnerabilities of our shorts. And so that's really this very disciplined, restrictive policy that we chose to take on. And it's been an interesting way to create an investment vehicle that really doesn't look like other hedge funds or the market.
Well, especially it did not look like other hedge funds or the market in the recently concluded, and for Scopia, quite glorious in anything more gratifying than that from the point of view of pure investing.
Yeah, it's extremely gratifying. It also comes after several years of pounding our heads against the wall and wondering, how is it possible that the market is so upside down? Even though we weren't making a bet one way or other on the direction of markets, we try to think very rationally about what's an interesting company and what's a not so interesting company, what's a defensible business model and what's a not defensible business model. And when we were in this period of interest rates that were effectively negative and a fetish for growth.
Microscopic.
Yeah, microscopic interest rates. It just created this level of speculation that was crazy. It wasn't, I would argue that it wasn't even as crazy an equity market as the internet bubble, or in some ways even as crazy as the housing bubble of 2008, in the sense that a lot of the equities that were bid up as a result of great business models that just theoretically that were taken to absurd levels. And there's a reason why something like a SaaS company trades at a high multiple of revenues. There isn't a reason for it to trade at 25 times revenues. And so you took a model like SaaS, which is great recurring revenues, high gross margins, but then said, don't worry about making profits, just increase your market share and we'll reward you and you'll be able to raise money at ever higher valuations. And that's where things just went bonkers, where people had no discount rate to get back to reality because the Federal Reserve was telling you that there was no discount rate. And so it very logically, as a reader of grants would understand, it very logically led to crazy speculation.
But one contrast to the dot-com era is a lot of the dot-com companies, like they had market caps in the hundreds of millions, and a lot of these SaaS companies had market caps in the tens of billions. And it just seemed like the level of froth and kind of speculative securities reached an absurd level, which I think was kind of expressed through the 600 or so SPACs that came to market within the 18-month period.
Yeah. So the SPAC market was a special corner of the market. I think that's right. I think crypto was a special sideline to everything.
Side hustle.
Side hustle. To everything that was going on in the equity markets. I would say, though, that in the dot-com bubble, there were a lot of companies that were clearly not going to benefit from the scale of the internet that were valued as if they were going to benefit. There were some of those in this most recent bubble as well. There were some companies that tried to have a veneer of cloud or call themselves SaaS. But back in 1999, there were a lot of companies that were just building websites that were valued at 15 times revenues. So I think there was at least a very strong echo from 1999. And I think in the end, you've seen that there are a lot of really interesting software companies that have come back to earth at this point at much more attractive valuations that will live to fight another day. They can be profitable. There were a lot of businesses in the internet bubble that will never survive. I mean, I started my career shorting companies like SaberTech and Smart Talk Telecom and CyberCare that just don't exist anymore. Some of these software companies won't exist anymore either, but I think there's actually going to be a higher level of survival than in the internet era.
Jeremy, in your year-end letter, you talked about 400 private software companies. By the way, SaaS is software as a service, no?
Yes.
Yeah. 400 private software companies with an average private valuation of $3 billion each. So that's $1.2 trillion for a lot of them. And it reminds me of Bitcoin, when Bitcoin was feeling better. And these $1 trillion things just kind of popped up during the long era as one of your mentors, Professor
Mihir Desai
at Harvard, the era of magical thinking. But I want to ask you, Jeremy, about the not altogether unpleasant 5 or 6 years in which you were on the outside looking in. Scopia got off to a great start. I mean, it started in 2001, and really excelled in 2002, 2003. It must have seemed as if the world was your oyster. And then 2008 again, 2008 and 9, way out in front of everybody else. And the period of your kind of your sunset. Sun, by the way, does rise after setting. Was kind of 2015 to 2020, those 6 years inclusive. And we Grant's Interest Rate Observer did write, I must say, a very fine essay on Scopia and its difficulties and its prospects. I thought rather rosy. Late 2021. In it, you were quoted as saying the wind is at your face. And I the other day I read a quote from Pablo Picasso, and he said, "The older you get, the stronger the wind blows, and it's always in your face."
That's really good. I love that. Yeah.
But so tell us about the cycles of being smart and then as dumb as a brick.
Yeah, it's a humbling business, and it's a business that doesn't celebrate longevity the way other
journalism
areas.
does.
Yeah. and you could see it in, and I'm sure you've seen it in investors that you followed who were presenters at grants conferences and subscribers to grants. That cohort of funds that started with us around in the aftermath of the internet bubble. There are plenty of funds that existed before, but there were a bunch that started right around 2000, 2001. And so many of them shut down between 2014, 15, 16, 17, 18. And the idea was that it was just too hard to do what we were doing. I remember I presented at a grants conference in 2006, and the theme was, don't get short with me. And it was about how most hedge fund investors were giving up on shorting individual stocks. And that trend just continued into the teens. And a lot of people just decided they couldn't add enough value to continue with the strategy. And so we stuck it out, and we continued to see that there was interesting opportunity, we thought. And we believed in the way that we invested as a way that we wanted to invest our own money. And we were honored to have anyone who wanted to come along for the ride, but it was a very difficult period. And it's hard for people who are drawn to this world that selects for people with great backgrounds and who have accomplished all kinds of stuff to then all of a sudden be told you're wrong day after day for years. So it's not like we were upside down.
You get used to it, though, you know.
Well, you like to say that you have this incredible self-deprecation about being early to things, but you know exactly the feeling that you have this sense that you know you're going to be right, and you just have to get through this period that's not making sense and try not to do harm to yourself.
Yeah, here is the temptation that you and Matt must have faced. Fortunately, as Matt told us in the same story that to which I alluded, the one we wrote in November, I think, of 2021, he said if we'd known that 6 years knocking our heads against the stone wall, we probably would not have chosen to do that. But as you went through this period, you did it in the full knowledge that your long ideas were massively outperforming the S&P. That was, as a pure long investing operation, you would have been very nearly at the top of the world, as you are, I think, properly restored to something along that altitude now. But was the temptation ever so strong as to be not quite resistible to relinquish the short side and just to do what you're demonstrably doing so well, is to buy stocks?
Well, to be clear, we, during that 2015 to 20 period, we did not massively outperform the S&P. Over our 20-year history, we've significantly outperformed the S&P. During that period, we did not outperform. We outperformed value indices, but we didn't outperform the S&P. And it was funny because I was on a panel at a conference during that period around 2018 with two very high-profile investors who were talking back and forth to each other about how this is a period where you don't want to be invested in off the beaten path, hard to understand businesses. This is the time where you want to be in growth tech companies with predictable growth.
Like everybody else.
Exactly.
Yeah.
But that was exactly what he was saying. And I thought to myself, wow, that would be great. It's too bad we didn't do that. Too bad that we didn't own FANG stocks. But we felt like where we add value to our investors is coming up with ideas that they couldn't come up with themselves. Okay. And not just for the sake of being contrarian, but because we should be able to add more value that way. But during that period, that was not the case. Over the course of our history, we've added the same amount of alpha, that outperformance, however you want to define it. Our longs have outperformed the index by about the same amount as our shorts have underperformed the index. So we are actually more distinctive to most investors for our short underperformance than for our long outperformance.
What was your maximum asset under management figure?
About $5 billion.
And you're now more?
About $1.5 billion.
Yeah. So that must have been a thing too.
It was a thing. It was a thing to see it rise. And on some level, it probably made us a little less nimble in how we could identify opportunities and get in and out of positions. It also led us to a more sort of insidious problem, which we got into, again, with all the best intentions, which was hiring lots of people to help us. Why not have more smart people sitting around the table? We found that we really enjoy cultivating talent, developing people, teaching people a method of investing, but we didn't realize how important it was to keep that team really tight and cohesive, and that smaller actually is often more energy and better efficiency than a bigger group, where it's easy to get kind of lost in the shuffle.
Hold on a second. So
Evan?
You really don't. So were these the supernumeraries who helped you win that indoor marathon at a time of 2:44?
Some of those supernumeraries are no longer with us.
Well, see, there's a plus and minus to these
Yeah,
things.
yeah.
You can't win those races without without horses.
Yeah,
Okay.
that could come back to hurt us.
In the midst of the 2020-2021 bubble, I spoke to one investor. He was a former member of the Value Tribe, and he was long a certain stock that I thought might have problems. And when I talked to him about it, he goes, you might be right, but if you're right, the stock's going to fall a little bit, but their IP is so valuable, somebody's going to buy them at a higher price. Or I could be right, and the stock's just going to go up. And he told me every time I've looked at value for the last 5 years, I've lost money. So I don't even look at value anymore. How do you stick to your knitting knowing that in the past, relative value, not relative value, but absolute value has worked, market neutral has worked, and how do you talk to your LPs to keep them on the same page as you? Because you have to educate them because they're getting the same signal that you are, which is that this doesn't work anymore and that we might be in a new paradigm like that other investor thought we were.
I think for us, the key is to, first of all, have a broad but not too broad view of what value is. From the very beginning, we thought we had this what seemed sort of novel at the time approach to looking at value in healthcare and technology companies that would be together maybe half of our portfolio, but in 2001 that was a large weighting in those sectors relative to other value funds. Today it's not. But we started with this idea that if we're going to look at those sectors, we have to have a little bit of a broad view of how you define value and be willing to look out a year or two, let's say, to see a very different picture for this company than you see today. Technical Graham and Dodd investing is don't talk to me about growth. I only want to know what is it worth today and what are the assets in the ground, not what might happen in the future. So we've always been willing to look a little bit into the future. That said, it has to be within the next 18, 24 months that we're going to see a very significant change in the outlook for this business that will lead to a fundamental intrinsic value calculation that makes our longs 50% undervalued and our shorts 25, 50% overvalued. And so we never enter into a trade where we think, well, I don't think it's really worth it. I wouldn't want to own this company, but the next couple quarters are going to be good. Or the market's telling us that this is an interesting asset, so let's just go along for the ride. We've always been completely consistent in that approach to how we look at stocks. So we never had to explain to our investors a new way of thinking or apologize for what we were doing because it's very clear. We're very transparent with them that that's how we look at the world. I think the thing that's hard is how do you fight the urge to switch and become like this investor that you're talking about who was willing to change his stripes in order to try to match the market. And we just don't do that. We try not to be stubborn. We're not arrogant value investors who will say the market's a bunch of idiots. They don't know anything. We're the smart ones. When the stock goes against us, we're going to add even more. We're very sort of willing to be humble about the idea that the market might know something that we don't know. But we're not going to make decisions based on what we think the market wants to see as opposed to what we really believe.
Well, ladies and gentlemen, the labor market is still tight, which brings me to our honored sponsor, Indeed. Agents of influence. No, I was reading some piece of copy. It's not part of the ad. Okay, I'm going to start this again. Oxford Agents. All right, okay. So, ladies and gentlemen, as you have been hearing and reading, the labor market is still rather tight, which brings me to Indeed, our honored sponsor. Indeed is the hiring platform where you can attract, interview, and hire all in one place. So you must not spend hours on multiple job sites looking for candidates with the right skills when you can do it all with Indeed. So find top talent fast with Indeed's suite of powerful hiring tools like Indeed Instant Match, assessments, and virtual interviews. Hate waiting? Yeah, who doesn't? So Indeed's U.S. data show over 80% of Indeed employers find quality candidates whose resume on Indeed matches their job description the moment they sponsor a job. So this says here, call to action, must read. All right, Indeed knows when you're growing your own business, you must make every dollar count. That's why with Indeed, you only pay for quality applications that match your must-have job requirements. So Indeed knows that finding people with the right skills makes all the difference when you're hiring a team of one. It knows hiring needs to be cost-effective when you're running your own business. It knows that when you're doing everything for your company, you can't afford to overspend on hiring. So visit Indeed.com/grant, Grant, to start hiring now. Just go to Indeed.com/grant, Indeed.com/grant. Terms and conditions apply, and when do they not? Cost per application pricing not available for everyone. Need to hire? You need Indeed. So we have been through this period, as Mihir Desai put it in his op-ed piece in the New York Times, of period of magical thinking, which periods, by the way, have been recurrent over the course of market history the past 200 years. Nothing exactly new about magical thinking. It's cyclically recurring. But we have been through a sub-doozy of a period of magical thought. And there appears to be a reaction against that. And where does this leave you now in the field of opportunity? Could you help us and our listeners understand what interests you now from the point of view of both long and short ideas? Let's start with the long side first. Maybe some of these victims of knee-high interest rates, not yet properly sized interest rate, but knee-high interest rate. Maybe some of these victims now, cast down as they have been in price and value, are appealing. Do you see much of that?
Yeah. So I think what's interesting, and I love that article by Mihir Desai, and I encourage people to go check it out on the Times website, because he really captures how crazy the period was and how outside of normal economic history the period was. And some of the same frustrations that we had trying to explain, not necessarily to our investors, but to people that we just meet in our lives about why the way we think about investing still makes sense when it seems so obvious that
Did anybody ever call you arrogant?
No. But I do think that what's happened as a result of this increase in interest rates, that, as you implied, are not historically high interest rates, but just higher than zero, has had an incredible tight correlation with the fall of this crazy era of speculation. So who would have thought that the owners of Cathie Wood's ARK ETF of innovative tech companies would have such tight inverse correlation with interest rates? Do you really think that the owners of the ARK ETF are sitting there saying, I'm going to hold this thing as long as the 10-year doesn't peak above 2%? I mean, that can't possibly be right? So how do you explain it? Yeah.
I think it works not from observation, but through the tightening of financial conditions that sets that kind of topples the sand pile.
Yeah, and there's just this tightening of the supply. There's the money that went into, that was created by quantitative easing, the ebbs back as quantitative tightening in all kinds of different forms, and there's just less money out there for that kind of speculation. But it's sort of of all the sort of invisible hands.
Yeah.
It's a pretty amazing example of it.
The Chicago Federal Reserve Bank issues something called a National Financial Conditions Index, and you can look at it on this wonderful website the St. Louis Fed has called FRED, F-R-E-D. And the Chicago National Financial Conditions Index is actually registering rather easier than normal conditions right now, so is relatively stringent as things now feel, with a 2-year Treasury yielding upwards of almost 5%. Now, still, it has scarcely begun.
Scarcely begun to reach a normalized level. In your mind.
To meet a cyclically stringent state of being in finance.
That makes sense to me, and we are avid readers of Grant's Interest Rate Observer, but we're not macroeconomists. We have our armchair opinions about how the economy works and where it's heading. But our feeling is that we're coming out of this period where there was this way overdue correction in interest rates that had a profound effect on the growthiest companies in the market. So one thing that we've talked about in our quarterly letters over the last few years is this curve of software companies, high growth software companies, and what their multiple of revenues has been over the last 15 years. And it was pretty steady for the kind of top quartile of high growth software companies to trade at 10 to 12 times revenues for a long period. And those revenues were growing over time. And so those stocks were going up over time. But over 2020, 2021, you just saw this parabolic move of multiples of revenue go from 12 times revenues to 15 times revenues to 20 to 25 to 30 times revenues. And that's where the real craziness was, this just complete dislocation with the gravitational attraction of the planet Earth. And now it's come back, and it's back down to 11, 12 times revenues. Growth is, for many of these companies, slowing because they've been forced to pull back on the growth at any cost mentality that their stakeholders were allowing them to subscribe to. And people are trying to figure out, what do we make of these businesses now? And in the wreckage, there are a lot of companies that are trading at 4 or 5 times revenues instead of the average of 10 to 12 and the peak of 25 to 30 times. And so it's been an interesting time to look in that wreckage for a broadly defined sense of value. So if you have a software company trading at 4 or 5 times revenues, it might sound expensive compared to a widget company. Mm-hmm. But if you have 80+% gross margins and you believe that you should get to a normalized operating margin of 20 to 30%, it could be extremely attractive to buy a company at 4 times revenues or 5 times revenues. And so the real interesting opportunity right now is to try to find what's out there right now that really has a good business model. Everyone's saying, oh, we could generate free cash flow if you just let us, but no one believes them. And they need to, in order to do that, they need to reduce their growth expectations. And so the growth investors aren't happy and the value investors aren't happy. And that creates an opportunity to wade in and try to figure out where are the interesting business models that people don't appreciate, are really great business models, but they haven't had a chance to prove them yet. And then there's a software company that we've been investing in recently called Elastic that fits that criteria. It's trading at 5 times revenues. One of the leading companies in enterprise search and tools for observing the health of companies' networks and infrastructure. It's an interesting business that is very widely used. It's like Linux, Red Hat, MongoDB, a bunch of other tech companies that started as freeware and have become open source code that have become built into a interesting, defensible, for-profit model of managing the business. And so we think it's down from it's down probably 65% from its highs, and it's trading at a multiple where we think the market doesn't understand how valuable their technology really is.
Elastic, huh?
Yeah.
All right. Well, the listeners to this podcast aren't listening for, they want their money's worth. What are they paying?
About zero.
Oh,
But at the same time, we're also interested in companies like Tempur Sealy mattresses, which trades at 15 times revenues.
Doesn't it strike you odd that everywhere you look, there's a mattress advertisement?
Yeah.
The subways seem to be full of people who want to go to sleep.
Yeah.
It's just
Everyone does it.
What's the Casper, right? Casper was one of these very hot names, and I think Casper even, am I right, advertised on this podcast.
They paid us, yeah.
And they didn't do well.
I don't think they ever made a profit.
It's a tough business, and this is the thing that's really interesting. So one of our partners, Jason Taub, who's just an incredible guy and great investor, spent a couple days 2 weeks ago at the National Mattress Convention. Were either of you there?
We did not take it to the mattresses, no.
So he went to meet with the various players in the mattress industry. Seems like the most boring industry in the world.
No.
Please tell us more. But it's an industry that is going through like crazy tectonic shifts in share. Serta Simmons is going bankrupt, the second leading player in the industry. Tempur Sealy is taking share. There's questions about one of the largest retailers, Mattress Firm, and whether they're going to be able to survive or whether they're going to have to tie up with one of the companies. And by going out into a world where there's a lot of confusion and misunderstanding, there's a lot of questions about who's going to want to buy a mattress in a difficult environment. We came out of COVID where people were so focused on building their nest and home improvement, and now that's over. So shouldn't this be a terrible time for the mattress industry? It is. The mattress industry is in a mattress depression. It's down not only from the peak of COVID, but from the
Is it flat on
pre-COVID.
its back?
That was a great.
Yeah,
that was
well,
a great.
It's just a little something.
Yeah, no, it's really good.
What happened to all the zero interest rate competitors, the Caspers, the Purples, who never made a profit but were able to raise money from venture capital to sell mattresses at a loss to consumers through
They
the
didn't
mail?
make a profit.
Are they
Some
still
of
here?
them
Are they disappearing?
Purple is still holding on. They're getting some traction at Mattress Firm, but Tempur Sealy is run by just an outstanding CEO. It's growing at all different price points. It's managing its profitability extremely intelligently. It's thinking about returns on invested capital the way we'd want to think about returns on invested capital. And it is surviving what is a very difficult environment for the industry because they're innovating in a time when other people aren't innovating and they have a profitable business model. So we like the idea that we can look at companies like Tempur Sealy that is more like a typical value company. It started the year trading at 12 times troughish earnings, and it's had a lot of stocks so far this year had a good run. But even now, we think it's trading at a very low multiple of 18 to 24 months out earnings, and that the world assumes that they're going to be a victim of this continued hangover of excess supply and weak demand for mattresses, when in fact you're already starting to see that unit demand is strengthening. It's not rapidly accelerating, but we're sort of bottoming out. And the more we start heading towards some sort of even slight inflection, they're going to benefit disproportionately because they're so well managed.
Yeah. Okay.
So-
well, I want to. I've always wanted to ask you this. I think I might have asked you about 2003, but I want to ask you. So, Jeremy, you started out as a freelance journalist,
I did.
and then you became a short seller and an investor. What is the more precarious of these two occupations? Typing for a living with no certain knowledge of where that copy might wind up finding a buyer on the one hand, or buying low and selling high in securities that the world wants you not to own or to sell. Which one of those is the less stable line of business? 'Cause I'm intrigued by the personality type I see sitting across from this table.
It is very similar. I would say that. I would say that the idea of looking for a narrative that's not well understood was the way I approach journalism, and it's the way we approach short selling. I think that what I like about short selling as opposed to journalism is that for journalism, it was very hard to find people who cared about the stories that I wanted to
Ain't
tell.
that the case? Ain't it so?
But you at least have a many decade long history of publishing great stories, and you control that process. So you can tell people that the housing crisis is nigh, even if it's a year early, but no one's going to stop you from telling that story. I found it very frustrating to come up with interesting story ideas and not be able to find a place. I had a great time being a writer, and I got to write about really interesting things and politics and human experience. But I love the fact that in the stock market, you can have an opinion about the future of a business, and no one can stop you from making an investment or shorting a stock. As long as you have the capital to do it, you can get into the market and express that view. And if you're right, generally you will be rewarded at some point. And as long as you're nimble enough to stay alive, which that is the hard part about short selling, is that you can be blown out of the water in a way that in journalism you're just ignored. But I think there is a real value in that kind of journalistic discipline of evaluating sources, digging into information, questioning the reliability of the information that you're handed by sort of established interested parties. Yeah. Exactly. And that's something that when we hire people, we're really, one of the most important things to us is finding people who are willing to think broadly about what is the truth and what's the future going to look like. It's not what's the future going to look like in 10 years, but let's do lots and lots of research and digging. We'll look at every financial report you can find, of course, but we'll also talk to so many people in the mattress industry or the software industry to understand what's going to drive demand for this product or service, and find a view that's really different than what the rest of the world sees. And a lot of the time we don't see something that different, and so we move on to something else. But when we can find something that's really different and can stand up to that kind of level of scrutiny, then it becomes exciting.
Well, there's a story, Jeremy, that they tell about a tourist in Midtown walking down the street, and he sees a guy carrying looks like a trumpet case. He says to him, "Hey, sir, how do you get to Carnegie Hall?" And the guy with the trumpet case, well, practice, man, practice. But in the case of Scopia, which has its headquarters at Carnegie Hall, the way to get to Carnegie Hall is through hard, self-disciplined thinking, tireless research, and above all, self-confidence and perseverance in one's own capacity to contribute and to survive in an environment that is often made most hostile by forces that you can't control. And no matter how many anathemas you hurl at them, they seem not to notice.
Yeah, that's exactly us.